Hello, hi there, welcome to a revision video where we're going to explore the extent to which businesses can use barriers to entry to maintain supernormal profits in the long run. This is a key aspect of your theory of the firm and market structures in year 13 economics. So entry barriers are basically any hurdle, any barrier that one or more challenger firms, new entrants into a market, must overcome to enter a market profitably. Now the key word there is profitable. So it's often the case that businesses can enter a market but they make a loss and they don't survive for very long. An entry barrier is the hurdles you must jump to enter a market profitably. Some of these entry barriers are structural. They relate to costs of the existing established firms. We'll talk about that in a minute. Other barriers are more strategic. They refer to the behaviour, the strategies employed by existing firms, or by legal barriers to entry such as licenses, trademarks and patents. Now in a monopoly, when demand is price inelastic, it's possible for a monopoly to make quite high supernormal profits. Profit maximising firm will produce an output of Q1 and be able to charge a price of P1. Of course, this assumes they're not price discriminating. So a single price monopoly has a price of P1 and the average cost is AC1, and therefore this area here, this shaded area, shows the level of monopoly profit. Now ordinarily, that high level of profit is a signal for new firms to enter the market. But of course, in a monopoly, there are barriers to entry. Indeed, to maintain supernormal profits in the long run, firms must be able to use entry barriers. And this is true, by the way, for businesses in monopoly, duopoly and oligopoly. So for any of those three market structures, entry barriers can be and often are significant. But it's not the case with monopolistic competition and also perfect competition, because in both of those market structures we assume free entry and exit of firms. So this is associated with monopoly, duopoly and oligopoly. So what are the main types of entry barrier that we might want to analyse and discuss? Well, the first is really cost. And the biggest single advantage an established firm can have comes from enjoying unit costs that are lower than a challenger firm, and we call this a cost asymmetry, and this results nearly always from exploiting economies of scale. A good example of this, perhaps the most extreme example, is a natural monopoly. Now with a natural monopoly there are significant large internal economies of scale available to the biggest firms, and this means there's actually a tendency for one business to dominate the market in the long run. So falling long run average cost provides a significant cost advantage for the scaled incumbent, the established firm. With the natural monopoly, marginal cost is assumed to be low in the long run. I've assumed it to be constant. The average cost keeps falling because you have the very high fixed costs of building and maintaining a network, whereas the marginal cost of supplying to extra users is assumed to be fairly low. So the key point here is that the average cost keeps falling as output goes up. And if we put in some revenue curves, we can profit maximize at Q1, the price is P1, the unit cost is C1, and again we have a high level of profit. The key point here is that it's highly unlikely for a challenger firm, a new entrant, to be able to achieve the same unit costs as the big established network providers, and this acts as a major barrier to entry. Another entry barrier is vertical integration. Now this can come about through merger and takeover, but also through just the strategy of the business itself. So vertical integration is where a business has control of pretty much all of the supply chain process of getting goods and services to the consumer, getting goods and services to market. And a good example I think is Tesla. Tesla is in the news, of course, one of the world's biggest electric car makers. I think they had something like 2/3 of electric vehicle registrations in the second half of 2021. They dominate the industry at the moment, although actually that's lower than it was a year ago. Companies like General Motors, Ford, Nissan, Audi Toyota are also trying to really drive up their sales and their market share in electric vehicles. So established firms have dominance. Tesla is interesting. This graphic, I think, illustrates this quite nicely. Tesla is interesting because it is essentially a vertically integrated company, and that's really gathered momentum. It's gathered pace since 2018. Look at the right hand side of this graphic. Tesla's operations is vertically integrated. They control pretty much everything, from showrooms to charging stations to the manufacturing of the vehicles, battery design, computer software, hardware, etc. Other traditional car companies, pardon me, might operate showrooms and manufacturing, etc., but often they outsource production to other businesses. So I think Tesla's a good example for your revision notes of a business that is highly vertically integrated. Now, is that an advantage for Tesla, or does that provide opportunities for other firms to maybe break into the market? Brand loyalty and product differentiation are two really important aspects of barriers to entry. Product differentiation is a key term in imperfect competition. This is where you have many firms, each selling different, slightly differentiated products, either in terms of actual physical appearance and nature and quality, or by design, by branding and marketing. Now, often with product differentiation, what firms try to do is they try to saturate the market themselves pardon me, with a wide range of similar branded differentiated products. If you saturate the market, the established firms, that makes it tougher for a new firm to enter the market and find a profitable gap in the market. So a really good example of this is probably the market for soft drinks. There is absolutely fierce battle for retail space, and obviously it's dominated by the likes of Pepsi and Coca-Cola and others. It is pretty tough when you're competing against the big boys. That is essentially a duopoly in the market. It's not impossible. You have to find a profitable niche or a segment of the market where you can find a gap. So product differentiation by a firm can increase barriers to entry, the focus of this video, because it makes it harder for a new firm to find that profitable gap in the market. One of those interesting businesses that I've been focusing on recently in my own teaching is Gymshark. Highly popular amongst people in their late teens, early 20s, even early 30s, dare I say it, even older than that. Here's Ben Francis, the co-founder of Gymshark, and they have relied heavily on social media and social influencers, to generate sales and promote their brand. They're obviously trying to take on the likes of Nike and Adidas and many others. Pardon me. And it's a big challenge to take on these businesses, and they seem to be doing it pretty well. A UK sports brand that's doing rather well in the UK and overseas as well. And then we have other barriers to entry. If you have control of important platforms, Amazon Web Service has built a huge platform for hosting businesses and things, and they have huge market control. Don't underestimate the importance of expertise, goodwill, and reputation as well. If you've been in the market for some time, you build up expertise, market intelligence, you build up consumer goodwill and brand loyalty, you build up reputation, and that can act as quite a significant entry barrier. The image I've chosen now is QuickFit, which is a well-established sort of car, auto repair and MOT business that has a terrific reputation. And then on the bottom right, we look at legal barriers. So things like patents, licenses, trademarks. These are legal barriers to entry. Now, a patent can provide monopolistic barriers to entry because other firms can't use the patent. So, for example, a pharmaceutical company might have a patent for a new drug for between 7, 10, 15 years. Whilst that patent is live, no one else can sell that particular patented drug. Good recent example, Ocado, the online grocer, has won a patent dispute with a Norwegian rival. I think this patent dispute was about the use of robots in the distribution process. A lot of companies now are scampering, bidding to win patents. It gives them a legal advantage. And of course, a huge issue at the moment is the issue of patented vaccines and therapeutics in the pandemic, and the extent to which drugs companies should perhaps waive their patents to allow new brands of antiviral, anti-COVID patents, drugs and things, and treatments to emerge. So patents is quite a controversial aspect in the economics literature. In theory, patents provide quite a strong barrier to entry. So when entry barriers are high, established, existing, incumbent firms with market power, they can continue to earn supernormal profits in the long run, key point there, and also therefore generate better returns for their shareholders. If there are high entry barriers, then a market tends to be less contestable and will tend towards monopoly, duopoly, oligopoly, and so on. However, many people think that entry barriers in lots of different industries and markets are actually coming down. So a good evaluation is to ask this question: are barriers to entry in markets getting lower? We've seen the rise of lean startups. These are startups which try to break into a market with very low costs. They try to establish a presence in the market using a minimum viable product. Get a product into the market. You can continue to change it, iterate it, improve it over time, but try to break into a market with minimum cost. We've also we're seeing the growth of businesses prepared to use disruptive pricing models, particularly based on algorithms. So, the likes of Uber coming into the sort of ride-sharing market, the rise of Ryanair breaking low-cost airlines, breaking the existing market power of the dominant flyers. Loads of businesses come into markets. They can overcome the barriers to entry because they have different pricing models. Viral marketing via social media can cut the marketing costs of attracting new sales. I've mentioned Gymshark. Think about businesses like Depop. If you get your viral marketing correct, it can be quite a powerful force and therefore brings down the marketing cost of market entry and therefore brings down the barriers to entry. Many firms, instead of having to buy equipment, buy shops, build factories, many firms now lease equipment in retail space. The rise of pop-up shops, for example. So the rise of the sharing economy can help to bring entry barriers down. And so too the availability of open source software, which brings down the costs, the cost of small businesses, for example, establishing a digital presence on the internet. A lot of businesses now are running very flexible manufacturing systems, so they're not engaging in mass production, batch production on an enormous scale. Instead, they're looking to produce smaller print runs or production runs and customizing things for individual consumers using things like 3D printers. And crucially, I think this last point is perhaps my most important point, and it's one I'll finish on. Many entrants into markets where there are barriers to entry are actually businesses that have already scaled production in other industries or other countries. So if you think about the retail grocery sector in the UK, for example, dominated for years and years and years by Tesco, by Sainsbury's, by Asda, by Morrison's, by the Co-op. Of course, we've seen the growth of Aldi and Lidl pursuing rapid growth strategies, opening hundreds of stores, breaking into the market successfully and being profitable at the same time. A good example of two businesses that have overcome many of the entry barriers, including preconceived existing consumer loyalty. But they were already big success stories in Germany before they came in. They were already scaled businesses. It is easier to break into a market when you have already scaled your production in one or other markets. So there we go. Barriers to entry are any factor that prevents or makes it tough for new firms to enter a market profitably. The nature and the scale of entry barriers changes over time. So I think this is a key area of the course where you can certainly add contextual examples to your notes to make your answers stand out. Huge thanks for joining in today. We always appreciate it. We don't take it for granted. Please look after yourselves. Take care, stay safe, and see you again sometime soon.